The spring market is in full force. Lots of buyers are out shopping, lots of contracts are being written, and lots of contingencies are being waived, which brings us to this week's topic, appraisals. We're asked all the time, do I need an appraisal? And what if the appraisal comes in low? Well, first off, is an appraisal necessary? For most loan programs, yes, it is. There are certain times when an appraisal waiver can work where the lender does not require an appraisal for a specific property and price point. That's going to be very specific in that to get an appraisal waiver, one, it's got to be a Fannie Mae or Freddie Mac conforming conventional loan. It's got to have a sales price of less than $1 million, and it's got to be at least a 20% down payment, and it is property specific. So if you're putting 20% down, buying a property under $1 million, please make sure you reach out to us, your lender, and ask them to run the automated underwriting services, both Fannie Mae and Freddie Mac. That will give the results as to whether an appraisal is necessary or not. Second is what happens if the appraisal comes in low? Well, that brings us to this week's total cost analysis. I'm going to show you for a client that is looking for a home and looking at a home in Fairfax, asking price $775. Client is considering putting in an $825,000 offer, 10% down payment, and is wondering what happens if the appraisal comes in low. Well, taking a look at the total cost analysis, the first column shows the ideal scenario. $825 sales price, wins the contract, 10% down, 90% loan. We've got rate, we've got the payment, we've got cash to close, $103,000. Well, what if the property does not appraise? It comes in at asking price, so a $775,000 appraisal. Well, $825 sales price. Now that 10% down loan, 90% loan to value is based off the appraised value instead of the sales price. Loan to value is always going to be from the lower of the sales price or the appraised value. Rate stays the same. Payment drops in this instance because the loan amount's going down, so the payment drops $300, but cash to close goes up $45,000. Not ideal. Well, one way to get around this, or to rework this, I should say, and have a $50,000 gap possibility is, again, $825 sales price. Now, instead of doing a 90% loan off of the $775 value, so 10% down, we do a 95% loan off of the $775 value, so $736 loan instead of $742. Interest rate stays the same. Payment goes up $19 a month, negligible. Cash to close goes up $6,000 a month. Not bad. So $19 a month more payment, $6,000 more cash to close, allowing the buyer to bid $50,000 over, have a $50,000 appraisal gap, and keep everything still pretty much in line. Another scenario would be that we're considering is if we had an $825 sales price and it appraised at $800, if we kept the loan amount the same as the original desired loan, interest rate stays the same, payment goes up $60 a month, mortgage insurance, keeping the cash to close the same. So now we've got two scenarios that are viable. This is something that if you're looking for a home right now and are bidding over price and are concerned about the appraised value, reach out. Happy to put together hypothetical scenarios on a total cost analysis to show you what it could look like. If you're shopping for a home, your lender should be giving you property specific numbers up front. Hopefully they're not sending you PDFs like it's 2005, and they're giving you a total cost analysis to show you different scenarios of down payment, loan amount, etc. Please, if you'd like a TCA, reach out.